Chapter. We're talking real money.
Hi, everybody. Welcome to Talking Real Money, the show that's all about you and your money, you and your dough. The show about dough. I'm Don McDonald. Right there is Tom Cock, and you are listening. Thank you for doing that. We really appreciate you. Now, if you're just listening, that's great. But if something's going on in your financial life and you're thinking, gosh, I wish I could talk to somebody about this, and I wish I could talk to somebody about this who isn't likely to try to rip me off. We know there are no guarantees in life, but if you've listened to us for any time at all, you probably have realized, oh, yeah, these guys aren't going to rip me off. That's not what they
It's hard to do over the radio.
Anyway. Well, it's hard to do over the radio, but it's been done.
It has. Boy, has it. Yeah.
So, I don't, and so many talk radio shows about money are really lies and obfuscation as opposed to information.
They're a pitch.
They're a bad pitch. I just listened to that other show we talked about last week on the radio in the Seattle area. It was horrible.
Not surprised.
It was, but the pitch is very veiled. You've got to go to their seminar. And that's where you're going to find out that...
you're going to find out, all right.
The stock market is too risky. We're going to show you a safe way to invest.
Still make the money, but take no risk.
Yeah, but no risk. Now, what could that be? A lie. That could be a lie. That will be a lie. A fib. So, anyway, we want to help you out. And I was getting to the phone number. I'll go try that again. 855-935-TALK. TALK, or 8255 is the number. 855-935-8255. Call us on Saturdays. We'll talk. It's free. It's easy. It's easy and free. And we want to cover almost anything that's important to you and your future. Now, we talk a lot on Talking Real Money about investment vehicles. Now, when we started doing this, way back in the olden days, the only kind of investments there were mutual funds. They started back in the 1920s, and they stuck around for a long time, being the only great diversified way to invest.
Just so you know, we were not on the air in the 1920s. Close, but not there yet.
Not quite yet. As a matter of fact, 2025 is the 40th anniversary of Don's first talk show.
Wow, that's a long time
40
ago.
years ago.
Well, 50 for me starting last year, but I was a whole bunch of other things before I did this.
Yeah, you
Disc
were
jockey,
a jockey.
news guy, TV guy, and a whole bunch of stuff.
See, the whole time I was like a talk show host.
You've been the same guy for 40 years. Good for you.
But there's a new-fangled investment that cropped up several years ago that we were reticent to support because it was newfangled, and we've got to be, we're not Missourians, but you better show us. And that was the ETF. Well, now the Exchange Traded Fund, or ETF, is taken over.
It's having its day in the sun. I mean,
no, it's taking over. It's just winning.
And we've said this previously, but I think within 10 years it will be the dominant investing vehicle. Better tax treatment, can buy and sell no cost, can basically buy any product at any custodian. So the exchange traded fund, which is similar to a mutual fund but different for the aforementioned reasons, added over $1 trillion last year. They're over $10 trillion in assets now. I can remember when it was just a few hundred billion. But here's the part that's interesting. I mean, there's nothing to sneeze at. That's a whole lot of money, right? I mean, major custodians now have a major part. The biggest inflow last year, take a guess, the QQQ, which, of course, is the NASDAQ 100.
Always chasing the hot stuff, aren't people? They're always chasing the hot.
The biggest, though, and after that, it goes down to, guess what? The Standard & Poor's 500. People flocking to the Standard & Poor's 500 because it had two of the greatest years it's ever had. Up over 20% the last 2 years each year. That's unbelievable. Which helped make VOO the Vanguard 500 at the biggest at $116 billion now, ETF. IVV, which is what? What is IVV?
IVV? I don't know. I have to look.
I forget that one. I think that's also the S&P 500. I didn't tell you this in advance.
That is 89. The iShares Core S&P 500.
Same diff, basically. And then the fund that I think you should run and hide from, and this is what worries me about exchange-traded funds.
So we're now where? We're
number 3.
1, 2, 3. Okay.
Yeah, we'll talk more about it in a minute. Yeah.
Yeah, I want you to hold this. So this is the third biggest?
I believe that's correct.
Third biggest.
Yeah.
And really, the one oh my gosh. You got to stick around and find out what the third biggest is.
Stay tuned.
Oh, this is sad. 855-935-TALK. Call.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
I gotta say I'm sorry. I gave some bad information a minute ago. I just went back and looked at this in terms of the exchange-traded funds. Now, the numbers I was sharing was the growth of the fund in 2024. So the fastest grower was VOO.
VOO, which is the S&P 500.
Correct. Yeah. IVV, which is a similar fund, $89 billion. And then the one that
number 3 on those fastest growth in 2024.
Correct. That would be IBIT.
For those of you playing along at home, that is not an ibis, the bird loved by the Egyptians and running up and down the streets in Florida. No, it is the
iShares Bitcoin.
I just don't even want to say the word.
Yeah, Larry Fink should be. Anyway, so it took in $37 billion last year.
Now, bear in mind,
and then dumped out a whole bunch at the end of the year after it went down a couple of days. So.
This is its first year in existence. I think
it must be second because according to this source, it has over 50 bill in total.
I'm sorry. It started in January of 2024.
These are conflicting numbers, and that's interesting.
Yeah.
You're right. I think it was approved. So, fast growth.
And its average annual return? What's the average annual return for like VOO?
Average annual return?
Or just the return 10%. For this past year. This
last year, 24.
Yeah, 24. What's the annual return this year for IBIT, the Bitcoin Trust?
For 2024?
5.5%.
80%. What?
5.5%. 5.5%.
After all those ups and downs and ins and outs.
I'm looking at the chart.
Crazy.
It started on January 3rd.
Okay. There you go.
And
but this tells you everything you need to know about that fund. The ease of trading is a bad thing in this case because you're trading it a lot. That's why so much money flowed out of it at the end of the year. When it went down a little bit, people said, well, I got to get out. Not if you believe in investing in Bitcoin.
I messed up too. I messed up on my numbers too. I was looking at year to date.
This year.
We're already in a year to date this year, apparently.
So
3-month return. Yeah, 3-month return is 61.18. When did it start? Now I got to look back because I
think you're right. It hasn't been around very long, but
I just want to make sure.
While he's doing that, this is not a fund we would recommend.
Yeah, it started in January of 2024, the 31st. Okay, yeah, I was right.
So it's taken in a lot of money. It's had a lot of volatility, and I suspect that will continue. So do not invest in that. No.
It's a fund of nothing. 855-935-TALK is our phone number. You know how many Bitcoins they own? Now, this one I know I'm right on.
0.
55,000 Bitcoins.
They own, okay, so I thought maybe they're just how much
do they have in real assets? 0. That is the correct answer. In intangible assets, they have nothing. In anything that is a true marketable security with a true asset value, 0.
But what the next guy thinks it's worth,
they have $55,000 or 55,000 individual Bitcoins.
Wow. They store those in the basement or something, or where do they keep that?
No, actually, you see. Wait, let me grab you this little bag. Okay, you see this little tiny bag?
Yeah.
That holds every single. See how small
all
this is?
All the securities are right in there.
It's only 6 inches tall, and actually, it holds about 1 trillion Bitcoin. This one bag.
You might want to put that in a safe place.
Look.
Never know.
There's lots of room for Bitcoin in there.
Yeah.
I hate Bitcoin. Let's see. I think we're going to head up to the chilly northern parts of the country, Minnesota. Mike, welcome to Talking Real Money.
Hello, gentlemen. How are you?
Good. Thanks for calling, Mike.
Yeah, it's about 10 degrees outside right now. So give me a call.
All right.
In the garage. Oh, you had to sneak out to the garage. Okay.
Yeah, he had to sneak out to the garage to warm up.
I see. Got the car
He's
running.
running the car.
Yeah, running the car. Yeah, so a little background. I'm 32. Always had State Farm as an insurance company for auto, home, umbrella, that sort of thing. I know that finding a fiduciary advisor is important, but is there such a thing as a fiduciary insurance agent with respect to like how much insurance I need, what kinds,
Nope.
and so forth?
No.
Now there are places you can get it without paying commissions on products, and PNC
not
shouldn't pay any
really.
commissions. Well, you can buy commission-free annuities in places.
Okay, annuities, but regular old insurance products. Are you talking about property, casualty, life, that kind of stuff?
That's what he said. Yeah.
Yeah, that kind of stuff, auto, home, just kind of the general.
No, it's shop till you drop.
Yeah, I mean,
basically.
and there's all kinds of places to go compare things.
Exactly. These are such easy products to compare.
Sure.
There is so much information available out there. Plus, you could go to an independent agent, one who represents multiple lines. And they if they ever want your business again, they'll probably try really hard to find you the best insurance for your needs.
And who runs
price.
Select Quote? I think that's who you can get fairly independent look at your life insurance needs, right? Doesn't that is? They look at everybody, I believe. I think so. I think you could go there if it was life you're looking at. PNC is as Don said, it's a bit of the Wild West. And that's something, frankly, everybody should check every year because a few years ago we did it.
I just have heard. Some negative things about Select Quote.
Oh, okay. I thought they were independent, but I couldn't guarantee.
They are kind of, but there's some things I don't know. I'm not going to say. I have just heard some things. I've read some things online about them creating some fake lowball quotes to get you in, and so I would probably. I got to tell you, if I shop around on my own. So when it comes to like property and casualty, I went to Progressive, I went to Geico.
You're the guy that got us off
Allstate.
USAA.
Yeah, I checked. I was on USAA, and then I found out that I could get much cheaper insurance.
I know. It was
anywhere
shocking.
but USAA. So I shop around, but if I wasn't a shopper for this kind of stuff, there's a guy who's well thought of in my neighborhood who's got a multi-line agency down the street. I'd probably go in there and he'd quote me Chubb and
he lives in a nice big mansion and et cetera.
Pretty average, but
all right, okay. Average mansion is it?
Pretty average.
So
well, Celebration is all pretty much average mansion.
I could say one thing though, pretty unequivocally, that if you're with State Farm, no offense to State Farm, it's going to be more on the expensive side.
Yeah. I think despite the fact that they Boondelay and Save.
Yeah, you could go to some others.
I hate that commercial so
I
much.
do too. TV commercials. Anyway, don't get me going. So you should be out looking around. And Don mentioned Progressive, where we both ended up after searching a few years ago. And I checked again. I checked again when I bought this house, and I got still a better deal. So
for life, I don't know who to tell you. I just shop. Does that help?
All right. Well, thank you.
Thanks so much for calling.
You might want to get warm.
Take a look at the independent agent type of deal. But
I think that's smart. Yeah. And if he's in the car, if he's in the garage warming himself up with a car, he should get life insurance real quickly.
Yeah. Because I think there's a poison gas involved.
It's not good. Yeah.
It's not good from what I've heard. Yeah. But it's warm is a choice.
10 degrees.
It's so cold. We'll be back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
This is one of the, okay, here we go. Select Quote has been sued multiple times for violating the do not call registry laws.
Really?
That they telemarket, because once they get your name,
they're going to call you.
They're gonna call you. So
you gotta make a living.
Gotta be careful.
I gotta finish real quick. I know we got calls waiting, but real quick, the ETF thing, because this comes up a lot. If you're going to use
back on that again,
just real quick, let me close the topic here. If you're going to use one fund, we're comfortable saying you could use the Avantis Global Equity Fund. That's one fund that holds the global stock portfolio.
DFAW?
That's dimensionals. I mentioned Avantis AVGE. If you want to do more work than that, I just looked at this again. Vanguard has the Vanguard Total US, VTI, the Vanguard Total International, VXUS, and then the Vanguard Small Cap Value, VBR. If you wanted to make it easy, you could put a third in each one of those. If you want an all-stock portfolio, that'd be a good way to do it.
Did anyone ask you that question? I mean,
all the time. I get asked regularly.
That's important. Tom's been getting a lot of questions lately. God. Holy cow. He's been taking phone calls like crazy, which really actually is the only part of his job he likes.
That's not true. I like coming home telling people here what to do.
That's not your job. That's your house.
Oh, okay. Well, it feels good.
He confuses the two, as his family will attest. Oh, you're not the boss of me. 855-935-TALK is the phone number. Everett, Washington's our next stop. Michael, welcome to our program.
Great. Thank you. Great to hear you guys, as always. I'm with a credit union here in Washington State, and I am wanting to move that money to one of the, places on bankrate.com so I can get a better rate. I wanted to ask if you have any recommendations, not only for the best rates, but also for good customer service as well.
Okay, wait, I got to ask though, Michael. Michael, what do you mean by customer service? Tell us more.
Yeah, you're not going to get any.
I'm not going to be on hold for 20 minutes before they pick up the phone.
They will never pick up the phone.
Yeah.
There has to be somebody from another country that I don't understand. That kind of stuff.
Yeah. I don't know that company, sadly, unless it's a small one.
I have to tell you that all of and I've dealt with many of the online banks. I've had accounts at Marcus. I've had accounts at Bread Financial. There's one other one I can't remember. And the reality is I never had cause to deal with a person.
And that's the key in today's world, because I just sent a very large amount to my mortgage people, and it took them 30 hours to find the large amount. And I kept calling is anybody paying attention to this? Well, yeah, we'll get to you. Again, if you're just looking for setting aside emergency money and you're going to put it in an account and pull it out when you need it, I don't know that you need a whole lot of customer service other than the internet working and be able to move your money. And that's really what those online savings accounts are designed for. They're not designed for you to call and ask somebody a question about them. They're simply there to pay you a higher rate because they don't have bricks and mortar. It's cheaper to operate, and that's why they can probably afford to pay you a little bit more than you get.
And by the way, I get a really, really high level of customer service from Bank of America. I really do. I get great service from Bank of America.
That's why they're paying you 0.1.
And they pay 0.3%.
Oh, pardon me. They just tripled your money.
Chase is 0.1.
Oh, okay. Wow.
Which I bet their customer service is even better.
People are standing by.
But I mean, think about it for a minute. Let me give you an example. I just looked this one up on Bankrate. One of the higher rates right now at Bankrate is a bank called Brio Direct. You ever heard of that?
No.
That's because it's a totally made up name. Totally made up name, but it's a division of Webster Bank in Connecticut. Not a household name.
No.
Your expectations for service from a little local bank shouldn't be very high, but they pay 4.75.
Yeah. And there you go. Yeah, I mean, which is great. So
here's what I do. I take my emergency money. I look around for a decent account, and Bread is still hanging in there at 4.5, so I haven't moved it. I put a whole lot of emergency money in Bread Financial. When I need some money, my checking account's getting low. You got to give them 2 days. I transfer a chunk over if I need it for something. And it's all done. That's all I ever do. It's just I use the app online. It's easy breezy, and I don't worry about the service. Thanks for the call. We'll be back.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
We believe investing should be boring, dull, like Harry Markowitz once said, watching grass grow or paint dry. It shouldn't be exciting, and it shouldn't be incredibly lucrative, just reasonably lucrative. And we want to help you do that. Call us at 855-935-TALK, 855-935-8255.
That was
when
a horrible. So you're just saying if you don't want to make a lot of money, you want to be very average, then give us a ring. Okay.
Yeah.
Wow, there's a pitch.
Are you kidding? Yeah, let me promise you vast riches like most of the
with no risk.
The special investment bankers on Wall Street do regularly. Now, what do you think? These guys, most of the people, the nice, safe fiduciary advisors, the kind we recommend, they make a good living. You can make six figures.
Yep.
But there's no chance any of our advisors are ever going to buy a sports team.
Well, it depends
on their
on
income
the team.
as advisors. What depends on
local volleyball team or something.
Team.
Okay. Oh, I see. Okay.
That ain't going to happen. However, the big shot investment bankers on Wall Street with the big investment banks, they're always looking for that big payday, which means they're always looking for that next special product to sell to you. Now, we've seen it. We've seen all kinds of things being pitched. They're legit, but not all they're cracked up to be. Collateralized mortgage obligations, collateralized debt obligations. Now, they can't do those anymore because there have been too many safeguards put in place. So what's the next big moneymaker for Wall Street, Tom?
Well, it's private credit. It's loaning money to people that the banks won't loan to or others because it's too risky.
Well, gee, that sounds
safe.
In
my day, yeah, it used to be called junk. Right? I mean, these are people that may or may not pay you back. Yeah. I mean, it's so, and there's a ton of money in this because two reasons, I think. Number one, after 2008, people looked at lending in general and said, I want to make sure I'm putting my money in something where I'm going to get it back. And the people that couldn't afford to go get those type of loans anymore had to go look somewhere else. That was one. And then the other was pressure from, and this is always where the problem starts, pressure from investors, banks, et cetera, who looked at interest rates for a long time and said, gosh, we're just not making anything in fixed income. We got to find an alternative to that. We got to find a place.
We need a better yield from our fixed income investments.
Exactly.
Yeah.
And then they said, well, there's this group of people that would love to borrow money, but they can't borrow it. We could loan to them and make a whole lot of money, and it'll be easy, which it is right now because people are paying back. And they want to go public with this stuff. They want to offer it to you. They have gone
public. Some of them have already gone public.
Yeah, but I mean in a bigger way.
Guys like Jamie Dimon at Chase.
I think he's right here.
JP Morgan Chase. He's sitting around going, guys, these are risky loans, and I don't care how you sugarcoat them or candy coat them. These things still could unravel in a big way. And because these are all private banking products, there's no federal oversight. And that concerns him and should concern you, too.
I would not put my money in one of the, again, it gets back to, do you need to put your money in one? Can you make enough? You said something about moderate returns from stocks and bonds. That's been the case. Here we're talking double digits. We're talking investments in companies that have to be riskier because that's the reason they can get this kind of credit.
They're so bad they can't even float a junk bond.
It's a good point, by the way.
They're so risky, they can't float bad bonds.
I hate the answer that the people that run these say is, we won't get in trouble because there won't be a run on the bank. We don't have depositors. We don't have anybody who says, okay, I need my money back today. Well, you certainly do if you go to the public because people have a tendency to say, wait, this is going downhill. Give me my money back now. And even these larger people that have backed them, you go back to 2008. There were a lot of big companies or big entities that said, let's get our money out now because we've got to meet our obligations and the amount of money we have is going down. So there were tons of those.
These are open to any accredited investor.
Yeah.
And these days, an accredited investor
it's a ridiculous
just means someone
number.
with $1 million in assets.
Yeah.
Which covers like 5% of the population.
But they're going to make these more available to everybody. That's their goal, is to make this
to put them in public vehicles.
Oh, of course. Sure. Because the real money's there. They're not dumb.
And the problem with that is going to be you will not know how risky they are. until they demonstrate that risk in a way that makes it impossible for you to bail. It's going to be too late by the time you realize it. Best avoided. High returns, reported low risk. Avoid. 855-935-TOM.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Want to ask a money question? Well, ask us. It's easy. Just call us at 855-935-TALK on Saturday from noon to 2 Pacific time. 855-935-8255. If that doesn't work out for you, then you can go to talkingrealmoney.com, click on the button that says Contact Us up in the upper right, and type us a question or speak it for the Friday Q&A episode. And Tom has one of the typed ones there, I believe.
I do. It comes from Luke in Evans, Georgia. Good morning, Tom and Don. Got that part right. I'm going to switch from a robo-advisor to self-managed investing with Fidelity. My portfolio will consist of 15% in bonds, and the remaining will be a mixture of international, small, value, and large cap growth. Custodian, as I mentioned, is Fidelity. Which ETFs do you recommend, and will the dividends automatically go back into the funds, or will I have to direct that aspect of the account myself? Thank you for your time. Happy New Year.
Well, with ETFs, no, they will not automatically reinvest. They will go into the account, and then you get to do something else with them. Dividend.
But you can make it automatic reinvest if you want.
You could probably have Fidelity do it. But not with the ETF itself. A mutual fund will do auto reinvestment, but ETFs won't. And we like the dimensional ETFs and the Avantis.
Yeah, if you want to make it really simple, you could use AVGE, which, by the way, I just looked this up. That's the Avantis Global Equity Fund. It returned 11.8% in 2024. Or Dimensional Funds DFAW, which is also a global equity fund. For some odd reason I have yet to be able to discern, it made 13.8%, 2% more than the AVGE. It's operated a little bit differently, a different number of stocks in it. But it's a similar product. So either of those I'd be comfortable with. I think I also just mentioned if you want to spend more time, you could use the three funds I mentioned at Vanguard, VTI, VXUS, or VBR in a third in each one of those.
Along with BND for the bonds.
Right, for the bonds. So, which, by the way, BND lost 2.2% last year. I was a little surprised to see that. So
yeah, and I have to tell you, I would not. If I was going to use a bond ETF, I would not use Fidelity's total bond ETF. I can't believe Fidelity charges this much.
How much?
0.36.
That is a little. What is BND?
0.03, I believe.
So 1/10. Wow,
10 times higher.
Yeah,
BND. Let me just double check. I don't. I could be wrong. No, 0.03. 0.03 versus 0.36.
There'd be no reason to pay them that much more.
So
absolutely none.
The Fidelity fund is 12 times more expensive. 12 times.
Yeah, so if you're going to get a tank of gas and you're paying $4,
would you prefer paying 46?
Yeah, I mean it doesn't make sense. I mean, yet people do it every day for the same product. I know gasoline's a little different one place or another, but in this case, it really would be the same product. So
there isn't a $42 difference between two stations.
Not generally.
Not generally.
So but that's a great question.
But yeah, we really do we love the small and value tilts that Dimensional and Avantis give you. And we believe in the long term, in the wash, this will all kind of average out, balance out. 855-935-TALK is our phone number. Let's go to Kirkland. Costco, Kirkland. Pete, welcome to Talking Real Money. Kirkland's signature.
Yeah. Oh, thanks for taking my call. One question: with the new administration coming in and everything that's going to go along with it, which none of us really know, looking at it, what would you change in any way up or down your cash position on your portfolios?
Actually, see, I'm selling everything and I'm moving into Tom's bunker. I'm just going to hide out from now on.
I'm still digging it, so you might want to wait a couple of days. So yeah.
No, what do you? I don't. I
give us the scenario as to why you would need more cash.
Yeah.
Well, let's say that things were not favorable to whatever's policies are undertaken. Were not favorable to the markets, and the markets.
So to stock markets
really turned into a bear situation. Yeah, the stock.
Okay, so the
Okay,
market's tanked.
then I would own bonds.
No, but I see what he's saying.
He's saying shift to cash.
What you're saying, Pete, is that you'll know when it's the right time to get in
After you sell.
Yeah.
Oh. No. What I'm saying is, we all have a portfolio, or I have a portfolio. There's so much in there, equity, so much in there, bonds, so much cash.
Yeah.
So, given what you think may happen with the new administration, in other words, if you're bearish, I would expect you'd say probably want to make sure you have things cash position in the event.
No, see, because
I love this.
Hold on.
This is
Because
exactly right. Thank you.
Pete, the implication of that is, though, that's what I'm talking about, the end game. The implication is, okay, let's say for a minute, hypothetically, that I am bearish. I think bad things are going to happen. Now, I know that my prediction is worth no more than yours or Tom's, which means they're all pretty much worthless. But let's assume that's my position, and I'm going to sell and go to cash. I'm not going to stay in cash for the rest of my life, am I?
No.
Then I'm going to, but
When
then
are
I'd
you
have to know the right time to get back in.
Okay, no. Let's go back to the fundamental question. What do you think a cash position be in an average portfolio? 2%, 5%, 10%?
Well, okay, but that's a good question, because what you're equating cash to is an asset. In our portfolios, cash would only be held there for cash needs. There isn't a portion of the portfolio that is like set aside for ups or downs in the market. That has no relationship whatsoever.
Right. I only keep enough money in cash to take care of possible emergency needs.
Short term.
About somewhere between 6 months and a year's worth of expenses. Should I just, totally fall apart?
Okay.
That's it. Anything else is going to be invested.
Okay, well, then let me ask you this question. Looking ahead a year with the new administration coming in, would you bump that cash position, or would you say, I think it's fine?
I'd
leave it alone because we know that historically there have been all kinds of horrible expectations from various presidential elections. And in reality, the results have been a total surprise. There has been no big change. Doesn't matter what kind of administration is in place. For some reason, business just goes on.
Yeah, and you can also, even on the political side, see the difficulty in electing a new speaker, the situation here that people sort of think somebody's going to come into town and take everything over. Doesn't appear that that's the case. But even with that,
and that's never actually been the case.
I know, and even if we agreed with that, the theory, the portfolio management you're describing is called market timing. We do not ascribe to it because every market timer we know ends up with less money than the correct asset allocation and rebalancing, and that is it. There is no buddy who can tell you when to be in or out of the market. It just hasn't happened. We haven't found them.
And the only people who are going to give you a guess as to what might happen they can only base that guess on one thing: their feelings. I don't put much stock in human feelings as a prognosticative tool. I just don't think we do a good job predicting based on our feelings. And given the fact that there's no historical evidence that anything will happen any differently, I'm going to just stay invested.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
It's curious. We were talking about BND earlier, and I'm on the Morningstar page for BND. And we love Morningstar, by the way. Great information. But Morningstar, like so many others on Wall Street, wants to justify their more expensive existence because you can subscribe and get more detailed information. And what I found curious, I don't know that I noticed this before. Below all the facts about the fund, It says, will BND outperform in the future?
No, it can't.
But they said
That's a silly thing to say.
Subscribe to get our overall rating based on a fundamental assessment. It's a bond fund.
Well, it can't outperform bonds.
It can't
the aggregate
outperform
bond
the bond market
that's
because
what
it is the aggregate bond market.
I mean, it can underperform because it charges 3 basis 0.03, but it can't outperform.
Right. It'll outperform the Fidelity Bond Fund because I wonder now.
0.36. All right. While you're doing that, I do want to mention, and we mentioned
you're
this
not going to
last
mention
hour.
Retire Meet again.
I am,
you?
because time is it's ticking. If you want to come out and see us on February 8th in Bellevue at the Maidenbauer Center, it's a wonderful 3/4 day, includes breakfast and lunch. A lot of great speakers. We've done this for 10 years, and yes, we have sold it out every year. This will sell out again quickly. So if you want to come and see us that day, we would love to see you. Don will be there. Yeah, coming up from Florida, because who wants to stay in Florida this time of year? Coming up to Seattle.
It's only 62 degrees here.
It's horrible. And Paul Merriman's going to be there. Kevin Peterson on Medicare. You know, Herb Weisbaum on consumer, et cetera, et cetera. Great speakers. It's a wonderful lineup, and we only get compliments on the day. So come and see us Saturday, February 8th in Bellevue. Retire Meet. That's where you go. RetireMeet.com to sign up now for tickets. So do it if you want to join us. Don't wait.
Do it. Don't do it if
inevitably
you don't want to join
call.
us.
Yep. No, that's true. Don't do it if you don't want to join us. So there you go. How's that?
All right. So let's see. Yeah. I'm just looking. I want to see if this actually worked out. The 10-year average annual return for FBND, which is the Fidelity Total Bond.
Okay. That was FXNAX, but okay.
No. They're ETF. I want to compare apples to apples.
Yep.
It's the 0.36.
10 years.
It's 2.17.
Yep.
Okay. The 10-year on the Vanguard Total Market Bond?
BND.
1.29.
I guess we were wrong.
I know.
So somebody has to go in and figure out why that would be under. We'll give that one to Paul Merriman. He'll know.
I wonder why.
Yeah, that's strange. Unless did it start the same day?
Yeah, apparently there is a difference in their portfolios.
Must be.
Now I have a conundrum. I have a mystery.
You got a project. You got something to do. A reason to stay alive till next Saturday's show.
Thank goodness I have something. I love having things to research.
Oh, you love this stuff.
I do. I love little mysteries like this.
Yeah, this will be a good one.
I don't want to solve a murder mystery or anything.
No.
Even though I do enjoy those shows.
We'll take it up next week.
A murder mystery?
No, that's way above our pay grade.
Going to say we don't do murder mysteries.
No. Money mysteries? Sure.
I'm getting to near the end of Only Murders in the Building. So
not seen that one.
You haven't seen Only Murders in the Building? This year is a little bit bizarre. This season, it's very strange. Great cast, though. I mean, Glenn Close.
It's always good.
Melissa McCarthy, of course.
Always good.
The leads. Anyway, we got to go. Hey, if you want to learn more, just go to talkingrealmoney.com. Not about murders.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.